The subprime crisis has made it very clear that the banking industry needs substantial reform. That's certainly a fact, given the risks they've taken, given the incentives that they've created for their managers and their loan underwriters and their investment managers. It seems very clear that the banking industry needs significant change, and we've been seeing a lot of that change happening in crisis mode with government intervention, trying to rescue banks that are failing, trying to force mergers of banks, trying to help create markets for illiquid, risky assets. So something needs to change. I'm typically not in favor of additional regulation, but in this case, I think I need to change my position and support some additional regulation for the banking industry, because and I should say not just the banking industry, but financial services and financial institutions more broadly, which would include investment banks, fund managers, insurance companies, etc. So by saying banks, I don't just mean commercial banks, but I mean financial services firms in general. They've created some very, very complex organizational structures and financial instruments for which they are not bearing the full amount of the risk. And these instruments have become very difficult to price. And there's a fair bit of information asymmetry and uncertainty surrounding these instruments. So I do think we need to reconsider how to better regulate the financial services industry, banks, insurers, investment bankers, hedge funds, and the instruments they create. Now, I don't have at the moment a good suggestion for what those new regulations should be, but I think the current crisis we're in calls for a re-examination of what regulations might be needed and might be effective. I think the bigger issue that the current subprime crisis and the credit crunch has created is a regulatory issue that is inextricably tied to the corporate governance issues that have revealed themselves. It seems very clear to me that banks, insurers, fund managers, investment bankers have faulty corporate governance schemes and faulty incentive mechanisms. I don't think we're seeing bankers, investment bankers, investors bearing the full risk and reward associated with the instruments and the positions and the arrangements they've created. So in my opinion, the strongest need is for much sharper corporate governance, perhaps also supported by additional financial regulation. The confidence in accounting information has been undermined significantly in the last 10 years or so, starting with major corporate failures like Enron and continuing through the recent many cases of financial failures of banks and investment banks and insurance companies and mortgage origination companies. The question becomes, how come the accounting information didn't do a better job of reflecting the risks that these firms were taking? Why didn't the auditors do a better job of applying the accounting standards that are in place? Why didn't the auditors and the firm's accountants themselves, why didn't these accountants do a better job of measuring these very complex financial instruments that they had either created or invested in? I think the accounting standards are reasonable. I think the accounting standards that exist under International Financial Reporting Standards or U.S. GAAP are good standards. I do think we need better standards with more guidance in how to measure fair values for these types of complex financial instruments. But primarily, I think the corporate executives, the corporate governors, need to hold themselves more accountable for how they apply these accounting standards, and the auditors need to be tougher on them so that they're applying the standards properly. And then, as always, our securities market regulators need to be stronger in terms of their enforcement of these accounting standards. Through those steps, I think we can restore investor confidence in accounting information. And right now, investor confidence is understandably very, very low in the quality of the accounting information and in the quality of the audit opinion. To what extent did the accounting rules help contribute to or exacerbate the current credit crisis we're experiencing? And does that call for a re-examination or reconsideration of fair value accounting? Absolutely not. I think the fair value approach to accounting, particularly for financial instruments, is the right way to go. If anything, fair value accounting helped reveal the credit crisis sooner than historical cost-based accounting would have revealed the crisis. It helped, or in fact required, investors and managers and regulators to deal with the crisis sooner, and ideally it will help shorten the length of the crisis and reduce its impact. Fair value accounting, in my opinion, for financial instruments requires that we measure or estimate what financial instruments are worth in the current market. When you are in a financial crisis, what do you want to know? What are these securities worth? If I can sell them, what will I get for them? If I can settle these liabilities, how much do I have to pay to settle them? That's exactly what the bank regulators need to know. It's exactly what the bank boards of directors and managers need to know. It's exactly what investors need to know. So the time when fair value accounting serves its best purpose is during times of crisis. Now, did fair value accounting help exacerbate the problem? It may have, to a slight degree. Fair value accounting requires that financial instruments be marked to market value when those market values are observable. When you see other firms marking down the fair values of securities similar to the ones you have, it requires that you mark down your securities. That could help drive prices down for those types of securities. At the end of the day, ultimately, those securities' values are determined by the cash flows they will produce and the risks that are associated with those cash flows. The accounting, whether it be fair value or something else, simply reflects our estimation or the market's estimation of what those securities are worth. So, did fair value accounting create or exacerbate? Did it create the credit crisis? Absolutely not. Did it exacerbate the crisis? If so, only marginally. But possibly, but only marginally. Is it the right way to account for these financial instruments? I'm convinced that it is the right way to account for these financial instruments. Can fair values sometimes be hard to estimate? Sure. But in accounting, we're not afraid of estimating things that are financially complex. We use models to estimate all sorts of things, like pension benefits or pension obligations, intangible assets, intellectual property, long-lived assets of a physical nature. That's one of the things we're good at, is using models to measure things that are difficult to measure. Financial instruments aren't any different, in my opinion.